how to use Option Simulator. Before proceeding further, I want to say that this is only a trial version where the number of tickers is limited to Nifty and Bank Nifty, and the number of expiries is limited to 3, 2 monthly expiries and 1 weekly expiry. In future we will have an advanced version which will be a paid one, where we will also have FNO stock options which are very liquid ones, and we will also have all the weekly as well as monthly expiries starting from 2019. So with this trial version, because you have 3 different expiries, you can also test several kinds of option strategies like calendar strategies, iron condor or some other option strategy. The idea behind making the option simulator is threefold. One, to use option simulator to visually backtest option strategies of your own idea, or if somebody said that a certain strategy works better, you can go back in time and visually backtest those option strategies and see for yourself whether it works or not. And the second one is to practice or to learn how to place option strategies. Let's say you want to learn how to do pyramiding in options when the market is very bullish or bearish. You can use option simulator to do and practice such strategies. And the third one is that you can use option simulator to learn how to repair or manage your options trades when something goes against your option strategy or trade. So with this in mind, this option simulator was made, and now I will show you how to use that. So first we have to select the ticker. So in this case we will choose Nifty index, and then you have to choose on which expiry you want to do this particular strategy. So now I will show one particular strategy with a weekly expiry so that I can show you this very fast. We will do a short strangle strategy where we will short out of the money call option and out of the money put option. Okay. So once you select your expiry, you have to then change the payoff date accordingly. Your payoff date cannot be greater than your selected expiry. So we will choose 24 October as our payoff date. So once you choose the payoff date, it automatically changes the start date to 10 days earlier than your payoff date, just to make it easy. But you can change the start date at any time. For example, in this case we will stick to 14th October because the weekly options are not liquid beyond 10 days. Okay. If it were a monthly expiry, maybe you could have selected 1st of October. But since this is weekly expiry, we'll choose 14th October, which is Monday. So once you select this payoff date and start date, it will show you what is the current time point. Okay, at current time point is starting of the 14th October 9:20 AM in the morning, right? And here the minimum time frame in the option simulator is 5 minutes. Okay, so you can proceed. If you have placed a strategy, you can proceed by further in future by 5 minutes, 15 minutes, 30 minutes or even 1 day. So depending on how fast you want to check your strategy, you can use whatever time frame you want. So for example, if you want to check an intraday strategy, maybe a 5-minute one will work better than a 1 day time period. So once you have this time point, then we'll say get option chain. So what it does is that it goes back in time and brings up the historical option chain for that particular time point, which is 9:20 in the morning of 14th October, and it will show that of which expiry this option chain belongs to. So this will be 24 October. So on the right side of the strikes, you will find the call option data like call delta, call IV and call LTP, which is last trading price. And on the left side, similarly, you will find put option data. So in this short strangle strategy, what we will do is that we will choose strike based on delta. So we will short a 30 delta option, both call and put option. So first we will choose call option 30 delta. So here is a delta column, call delta column. Go further down, and then this is the closest to 30 delta. So we choose 11,500 call to short. So once you say buy and sell, okay, click on buy and sell, then it will present a pop-up dialog where you can choose to sell or buy, or you can increase the lot quantity or decrease the lot quantity. For now we will use one lot and it will be a sell because we are shorting the option. And after shorting the 11,500 call, then we will also short a 30 delta put option. In this case it will be 11,200. So okay, and then we place this 11,200 put option. So we sold one out of the money call option and one out of the money put option. And once you scroll up above the option chain, you will see this payoff chart as well as the information about your strategy. And then there is a Greeks tab where you can see all the options Greeks like delta, theta, gamma, vega. And you will also see a profit and loss tab where you can look at the P&L of your option strategy. So now there are two conditions here in this particular strategy. One, we will exit this strategy whenever the loss goes beyond 50% of initial credit received. So in this case the initial credit received is 11,600, right? So the stop loss will be 5,500 approximately. So whenever you lose 5,500, we will exit the trade. And the second condition is whenever your positional Greek, okay, it goes beyond 25 delta, then we will manage the trade. I will show you how to manage the trade when it breaches the 25 delta. It could be minus 25 delta or plus 25 delta. Since this is a delta neutral strategy, our aim when we manage our trade is to make the positional Greeks as close to 0 as possible. So now we will proceed further by 1 day. Okay, you can also fine tune, like you can go forward by 30 minutes also, but to make it fast I am choosing 1 day. Okay, now we proceeded by 1 day further, so it will be 15th of October 9:20 am in the morning. So we are in profit right now. Okay, and your Greeks hasn't changed much, so we proceed further again, and now you can see the delta is close to 25, right? So now we can manage our trade. So what happened here is that the market has went up. Okay, so in this case we will roll up our put strike closer to the your futures price. So what we will do is that we cover this put option. So the current price is 35.4. So we will exit this put option. Okay. And then we go back to the Greeks tab and see what is the positioning Greeks. So it's minus 45. So now we have to neutralize this delta. Okay. To make it to 0, close to 0. So now we'll get an option chain for this particular time period. Okay. So we have to sell a plus 45 delta put option. So this is the closest to 45 delta. So we'll sell this one put option. And once we have done that, our positioning Greek is close to 0, right? That is the aim of a delta neutral strategy. Okay, now we'll proceed further again. Okay. Okay, the Nifty has gone up. So we'll check the Greeks. So Greeks has breached beyond 25. So now we have to manage our trade again. Okay. So we'll cover our put option again. 39.25 is the current price. So we use that to cover our 450, 11,450 put option. And we'll go back to Greeks tab and check what is the delta. So it is minus 61 delta. So again we'll get the option chain. And we have to sell a 61 delta put option to neutralize the delta. So this is the closest one. Okay, 61 delta. So we will sell this 11,650 put option. So now your positioning Greek is close to 0 again. So we'll check the payoff. Okay, it's good enough. Now proceed further for 1 day. So again the market went up. So we have to check if the delta is fine. No, it is not fine. So now here you have two options, right? We have already made two adjustments, right? Now you have to think whether you want to do more adjustments by because it will increase your transaction charges, right? If you are in a discount brokerage, maybe it doesn't matter much, but still. So you have the option of adjusting again or exiting the trade here. So now you have a profit around 5,000, and since you are shorting two options, so your margin will be around like 2 lakhs, so 1.8 to 2 lakhs, right? So you have around 2.5% of returns. So it's up to you whether you want to book profit here by exiting all the position or manage the trade by neutralizing the delta again. So let's do the trade management again. So here what we will do is we exit the put option again. 75.45 is the current price. So we exit the put option and we check the Greeks. So it's around minus 85 delta. So now we can get the option chain for that particular time point. It's around, and then neutralize with a 85 delta put option. So this one looks close. So 11,900 put option. We'll sell it and check the Greeks, and now we have neutralized the delta again. Check the payoff chart. Okay. So as you keep on doing more adjustments, the maximum profit possible, it keeps decreasing. Okay, we proceed further. 5,000. Greeks are in control. Proceed further. It's fine. So we are on the day of expiry. on the morning of the expiry. So we already have profit of 7,400. So almost close to max profit, right? It's more than max profit. So now we can close the trade here because there is no point of holding this trade because we have already reached a max profit. So now we have close to 3.7% of returns in 10 days. So this is a decent return, and we have done 3 adjustments for this short strangle. So this is how you learn how to repair the strategies. So you can go back in time. Let's say how you would have managed on the day when Nirmala Sitharaman has declared that the corporate tax is going to go down when there is a huge rally in the NIFTY. So you could go back in time of a September expiry and you would have checked how you would have managed these particular strategies on that particular day, right? So you can do all that kind of stuff using this option simulator. So now I will show another kind of strategy, which is a calendar strategy, where we make use of 2 different expiries. So again we will use 24 October as the front month. Okay, and again we are on 14th. So we select the start date again. So what we will do is that we will sell a put calendar. Okay, in put calendar we have to short front month or front weekly expiry, which in this case will be 24 October. So we will short at the money put option. So in this case we choose a 50 delta put option, which is 11,350, right? This is 50 delta, which means at the money option. So we will sell at the money put option 11,350 put. Okay, and then we will buy a 31 October 2019 11,350 put option. Okay, which is your the back month put option. So 11,350. If you check both of them, their delta is close to 50 because they are at the money strikes. So we will buy this one. So now this is how typically you will see your calendar strategy, put calendar strategy. So here your loss will be undefined, but they will be limited because you have a long option, backdated long option, and you have shorted a front weekly put option. So now we proceed further. So here we are not going to do a lot of management because managing calendars it doesn't make a lot of sense unless you are going to take some kind of directional risk. These calendars are not easy to manage. So either you book profit or book loss and exit the trade. So in this case you can have a condition saying that you are going to exit at 50% of your maximum credit received. So it's around 2,800 we will exit. Okay, we proceed further. So we are almost like at breaching the break-even point. So at this point we can just exit, right? Or we can do a modification. So I just wanted to show that you can also do calendar strategies using the option simulator. That's the aim of this how to use option simulator video. I hope you got all the information that is required from this video. Thanks for attending this video. Bye.